Hey there, curious minds. Welcome to the deep dive. We take stacks of information and, well, we dig through them to find the insights that really matter for you. Today, we're tackling a big one, something core to every organization. How do companies actually measure what matters?
It's such a crucial question because, effective performance management, it isn't just about crunching numbers on a spreadsheet.
Right.
It's really about understanding the engine driving the organization, figuring out how to motivate people, and, importantly, how to continually improve.
Absolutely. So our mission today is to unpack this whole world of performance management. We'll look at the financial figures, sure, but also those less obvious non-financial aspects that are just as vital. We'll check out the tools companies use, everything from comparing themselves to others to diagnosing things internally, and see how it all connects to the bigger picture of success. So yeah, let's see how organizations track their progress.
Yeah.
So at its heart, what are performance measures really trying to achieve?
Fundamentally, they're designed to give feedback. Feedback that motivates the right kind of employee behaviors.
Okay.
And the most effective feedback, well, it often ties directly to self-interest. The real challenge, though, is linking those measures clearly to incentives and the company's overarching goals, making sure everyone's rowing in the same direction.
That makes a lot of sense. So we know companies look at both financial and non-financial measures. Can you quickly clarify the main difference there?
Sure. Financial measures basically come from information you'd find in, like, GAAP financial statements or other financial reports. Think traditional numbers, revenue, costs, profits.
The usual suspects?
Exactly. Non-financial measures, though, they don't tie directly to those statements, but they offer other really critical ways to assess performance, operational health, strategy. They give you a much broader view, really.
Okay, broader view. Let's unpack one key measure that kind of bridges internal and external: benchmarking. What exactly is that?
Right, benchmarking. It's the process of measuring your own organization's processes, products, services against the leaders in your industry, or even best-in-class performers in other areas. It's essentially learning from the best.
Learning from the best. And the sources we looked at break this down into three types.
Yes, that's right. There's process benchmarking that focuses on understanding and really optimizing specific workflows, how you actually do things.
Okay.
Then there's strategic benchmarking. That's where you compare entire business models, the big picture approaches to strengthen your own long-term strategy.
More high level.
Exactly. And finally, functional performance benchmarking. That one's purely about comparing specific outcomes or metrics, like just the numbers.
Gotcha. So it sounds like you can benchmark against other companies, external benchmarking, or even look inside your own organization. Let's start with that external view. What's the main goal there?
With external benchmarking, you're analyzing how your business stacks up against others in the industry. The goal is really to pinpoint where you might be falling short, identify specific areas for improvement.
Finding the gaps?
Precisely. You might look at competitor products, how they deliver services, their marketing, key financial ratios, maybe operational efficiencies. It's all about understanding those competitive differences.
Makes sense. And a big concept within external benchmarking is productivity. How do we actually measure that effectively?
Yeah, productivity. It's defined simply as the ratio of outputs achieved to the inputs used in production. So it's a measure of efficiency. It lets you compare your actual performance against similar organizations or even your own past performance. Our sources highlight two main types. First, total factor productivity ratios, or TFP. This is a broad measure. It reflects the quantity of all output produced relative to the costs of all inputs used.
All outputs versus all input costs.
Right, so take Garden Furnishings, Inc. From our example, they made on 1,000 sculptures. Their total input cost, plastic, cement, everything, was $33,750. Their TFP is 1,000 divided by $33,750, which is about 0.03 units per dollar of input cost.
And the value is in comparing that number.
Exactly. You compare that TFP to your budget or last year's number, or maybe an industry benchmark to see how efficient you are overall with your resources.
Okay, TFP is the big picture. What's the second type?
The second type is partial productivity ratios, PPRs. These are more specific. They measure the quantity of output produced relative to the quantity of individual inputs used.
Ah, so focusing on one input at a time.
Yes, and it's actually the most frequently used productivity measure because it's so focused. Using the same garden furnishings example, let's look just at plastic. If they use 20,000 pounds of plastic for those 1,000 sculptures, their PPR for plastic is 1,000 divided by 20,000, which equals 0.05 sculpture units per pound of plastic.
And that helps you see how efficiently you're using just the plastic.
Precisely. You can compare that actual usage per unit against what you budgeted or what you used last year for that specific input. Helps you pinpoint specific inefficiencies.
Okay, so that's looking outward and measuring efficiency. What about looking inward? The material mentions internal benchmarking. How does that work inside a company?
Right, internal benchmarking. The goal here is to find the best processes within your own organization. You want to see who's completing work with the least amount of resources and effort.
So comparing different parts of the same company?
Exactly. You compare metrics, practices, maybe across different departments or product lines, even different factories or offices within the same company. It's about finding and sharing those internal best practices. Leveraging what you already know works well somewhere else.
Makes sense. And for this internal analysis, especially around quality, the sources give us some really interesting tools. Let's start with control charts. How do they help?
Control charts. They're really powerful graphical tools used a lot in statistical quality control. What they do is plot actual results, say batch by batch, against an acceptable range.
Visually showing if things are okay.
Yes, and more than that, they show if there's a trend or things getting better or worse. Imagine a tire factory. They set an acceptable range, say 5 to 15 defects per 10,000 tires. The chart plots each batch. Maybe all batches are within the limits, which is good. But the chart might also show a pattern, like defects slowly decreasing over time. Or, like in the example, maybe batch number 8 has 11 defects, still within limits, but maybe higher than the recent average or the downward trend. It immediately flags that specific batch for a closer look.
So it's great for real-time monitoring and spotting those subtle trends or outliers. Okay, once you've got a handle on individual batches, what about seeing the biggest quality problems overall? That sounds like Pareto diagrams.
Precisely. Pareto diagrams are all about prioritization. They help you figure out which quality issues are happening most often and therefore need the most attention. They visually display the frequency of different defect types, sorted from highest to lowest.
Like a ranked list, but visual.
Exactly. And the key insight usually comes from the Pareto principle, the 80-20 rule. The diagram might show, for instance, that by fixing just the top 3 most frequent types of defects, maybe that's only 20% or 30% of the types of problems you could actually eliminate, say, 75% or 80% of all the defects occurring.
Wow, that's a huge return on effort. Focus on the big hitters.
Right. It stops you from wasting resources chasing minor issues when the big gains are elsewhere.
Okay, so Pareto tells you what the biggest problems are. Then you need to figure out why they're happening. That's where the cause and effect diagram or fishbone diagram comes in.
Yes, the fishbone diagram. It provides a really structured way for managers to brainstorm and analyze the potential root causes of a specific defect or problem.
Looks like a fish skeleton, right?
It does. The head is the defect or the problem you're investigating. Then the large bones coming off the spine represent the main categories of potential causes. Typically things like machinery, methods, materials, manpower, sometimes measurement, environment.
The M's.
Often, yes. Then under each main category, you brainstorm specific factors of the smaller bones. So under machinery, you might list things like incorrect settings, needs maintenance, outdated equipment. Managers use this to systematically explore all the possibilities rather than just jumping to conclusions. It helps get to the true root cause so you can fix the problem properly.
It really seems like these tools, control charts, Pareto, fishbones, they shift the focus, don't they? From just reacting to problems to actually understanding and preventing them.
Absolutely. They transform raw data into actionable intelligence. It's about seeing patterns, prioritizing effectively, and then systematically digging down to fix the underlying issues. It's proactive improvement, not just firefighting.
We've covered a lot on processes and numbers, but performance isn't just what hits the financial statements, as you said. There are these crucial non-financial measures. What kind of things are companies tracking there, and why are they becoming so important?
You've hit on a really vital point. These non-financial measures give you insights that, frankly, the traditional financials might completely miss. Our sources mention several key ones: customer retention, employee turnover, labor productivity, and ticket response time.
Okay, let's take those one by one. Customer retention rate, CRR. Why focus on keeping existing customers?
Well, because acquiring new customers is way more expensive than keeping the ones you have. Retained customers mean sustainable business. They often buy more, they provide referrals, and give invaluable feedback. It's critical.
And how do you measure it?
The formula is basically total customers at the end of the period minus the new ones you added, divided by the number you started with. So the example, started with 1,400, added 240, ended with 1,500. So 1,500 to 1,400 gives you 0.90 or 90%. That means they kept 90% of the starting customers. The flip side, 10%, is the churn rate, how many you lost. Very important number.
Definitely. Okay, next, employee turnover rate, ETR. Losing people is bad, obviously.
It's incredibly costly, not just recruitment costs, but you lose expertise, efficiency goes down while the new person learns. It's a major drain.
How's that calculated?
Simple enough. Total employees who leave in a period divided by the average number of employees during that period. So if 32 people leave and the average workforce was 200, the turnover rate is 32,200, which is 16%. Tracking this helps companies understand workforce health and if their retention efforts are working.
Got it. Then labor productivity rate, LPR. We touched on productivity earlier. This is specific to labor.
Yes, it's focused on the efficiency of your workforce, measured as total output divided by total hours worked. Higher is always better. If a company makes 5,200 units using 1,300 labor hours, their LPR is 4 units per hour. And this isn't just looking back, it helps with forecasting too. If they maintain that rate and plan for 1,400 hours next month, they can expect to produce about 5,600 units.
Useful for planning. And the last one, ticket response time. Sounds like customer service.
It is. It's the total time between a customer submitting a service request or ticket and an agent giving that first response. The goal is always to shrink that time. Faster response usually means happier customers.
Right.
Think of an IT help desk. Maybe in February they averaged 4.5 hours response time on 120 tickets. By May, even with more tickets, say 150, they got the average down to 3.5 hours. That 1 hour reduction is over a 20% improvement. That shows real progress in service efficiency.
So these non-financials are clearly key for a rounded view. But then there are also these non-GAAP measures. What are they and why bother with them if you already have official GAAP numbers?
Non-GAAP. Good question. They're derived by taking the official GAAP numbers that's generally accepted accounting principles and then adjusting them. Companies do this because they believe these adjusted numbers give a, quote, better reflection of their core operational performance.
Better how? What gets adjusted out?
Often, they strip out things that might distort the view of underlying operations, or things that make comparisons between companies difficult. Things like restructuring costs, acquisition impacts, maybe stock-based compensation.
Okay, so what are some common examples?
Well, EBITDA is a big one. Earnings before interest, taxes, depreciation, and amortization. The idea is to see operating performance without the effects of financing decisions, tax structures, or non-cash charges like depreciation. Gives a sense of raw earning power.
Right. Hear that one a lot. What else?
Free cash flow. This is really important. It's the cash generated after paying for operating expenses and the capital expenditures needed just to maintain existing assets.
So the cash that's truly free.
Kind of, yeah. It's calculated as net cash from operations minus capital expenditures. It shows the cash available to maybe pay down debt, give back to shareholders, or invest in new growth opportunities. A very vital sign of financial health.
Okay. Any others?
Core earnings is another concept. This tries to isolate profits only from the company's main ongoing business activities. It strips out things like one-time gains from selling assets or unusual expenses that aren't part of the regular business.
Trying to get to the repeatable profit.
Exactly. And similarly, you have adjusted net income for non-recurring expenses. It takes the GAAP net income and adds back specific one-off expenses that aren't expected to happen again. Again, the goal is to give investors a clearer picture of likely future profitability, smoothing out the bumps.
Interesting. So companies use these adjusted numbers to tell a specific story about their performance.
You could say that. They arguably provides useful context. But regulators often caution investors to understand exactly what adjustments are being made and why.
Right. Transparency is key. So how do companies then structure their overall financial oversight, tying all these measures, financial, non-financial, GAAP, non-GAAP, to their strategy? The sources talk about financial scorecards.
Yeah, financial scorecards are basically frameworks for reporting and analyzing performance. They can be simple, like just comparing budget to actual results, or much more comprehensive. They often align with how the organization is structured into different segments or divisions.
And these segments are often called responsibility segments or strategic business units, SBUs.
Exactly. SBUs.
Hmm.
And the managers running these SBUs are typically held accountable based on specific financial measures, usually falling into one of four types.
Four types. Okay.
First, a cost SBU. Here, the manager's main job is controlling costs within their unit. Think like a manufacturing plant manager focused on production costs.
Makes sense.
Second, a revenue SBU. These managers are primarily responsible for generating sales revenue, like a regional sales office manager. Third, a profit SBU. Now, these managers are accountable for achieving a target profit level. That means they have to manage both revenues and costs for their unit. A product line manager might be an example.
Broader scope.
Yes. And fourth, the investment SBU. These managers have the widest responsibility. They're accountable not just for profits, but also for the return they generate on the assets invested in their unit. Think of a division head who decides on major capital investments for their division.
Got it. Cost, revenue, profit, investment centers. And companies can slice accountability even further, right? Like by product lines, geographic areas, or even by customer.
Oh, absolutely. Segmenting performance that way provides much deeper insights. For example, analyzing profitability customer by customer, especially for major clients, can reveal a lot.
Like whether a big customer is actually profitable.
Exactly. It might show that a large customer is actually costing you money, which could lead to decisions about renegotiating terms, changing service levels, or maybe even, in extreme cases, deciding not to continue that relationship. It allows for really granular decision-making.
That's powerful stuff. Now, the material then gets into contribution reporting, specifically for those profit SBUs. How does that work?
Right. Contribution reporting. It's a specific format for income statements used internally to evaluate SBU performance. It focuses on separating costs based on controllability.
Controllability.
Yeah, what the SBU manager can actually influence. First, you calculate the contribution margin. That's simply revenues minus all variable costs. This shows how much is available to cover fixed costs and contribute to profit.
Okay. Rev minus VC equals CM.
Correct. Then the next step is the controllable margin. You get this by taking the contribution margin and subtracting the controllable fixed costs.
Controllable fixed costs, like what?
These are fixed costs that the SBU manager can significantly influence within, say, a year. Things like local advertising budgets, sales promotion expenses for their region, maybe some supervisory salaries within the SBU.
Ah, okay. So costs they have some say over.
Exactly. And the key distinction here is between those controllable costs and the common costs. Common costs are things like central corporate administration, the CEO's salary, corporate R&D costs, incurred for the benefit of the whole company, but that an individual SBU manager doesn't directly control.
So you don't hold them responsible for those?
Generally, no. Not for performance evaluation purposes, although those costs do need to be covered by the SBU's contributions eventually. The point of controllable margin is to evaluate the manager based on what they can actually manage. The Delta manufacturing example in our source material shows this really well, breaking down performance for each region, showing contribution margin, then controllable margin. It gives management a clear picture of each segment's performance and the manager's effectiveness.
That makes sense, focusing accountability. This seems to lead perfectly into the balanced scorecard. It sounds like this approach gives a much more, well, balanced view than just looking at financials.
It absolutely does. The Balanced Scorecard is a strategic performance management tool. It goes way beyond just financials. It gathers information on multiple dimensions of performance, all defined by what the company considers its critical success factors, the things it absolutely must do well to achieve its strategy.
And it organizes these factors into specific areas.
Yes, typically four key perspectives. First, the financial perspective. How do we look to our shareholders? Still important, obviously. Second, internal business processes. What must we excel at internally to satisfy customers and meet financial goals? Think efficiency, quality, core operations. Third, customer satisfaction. How do our customers see us? Market share, retention, satisfaction levels. And fourth, advancement of innovation and human resource development, often just called learning and growth. How can we continue to improve and create value? Employee skills, technology, corporate culture.
Wow. So it connects strategy across the whole organization.
That's the power of it. It forces managers to consider how operational improvements, customer satisfaction, and employee development all link together to drive financial results. It translates the high-level strategy into concrete, measurable objectives across these four areas.
And the Instafab manufacturing example really brings this to life, showing how their cost leadership strategy translates into goals for each perspective. Can you walk us through that briefly?
Sure. Instafab wants to be a cost leader. So, financial perspective, goal is market share growth. CSF, critical success factor, is keeping customers. Tactics include expanding services. Measures could be their growth rate versus the industry or sales from new stuff.
Okay.
Internal processes. Goal is low costs via low prices. CSF is consistent production. Tactics mean better distribution efficiency. Measures might be comparing their costs to competitors or tracking perfect order rates.
Makes sense for a cost leader.
Customer perspective. Goal is being the low price leader. CSF is anticipating customer needs. Tactics involve boosting satisfaction. Measures look at their price versus competitors or customer survey results. And finally, learning and growth, or HR. Goal is linking strategy to rewards. Tactic is fostering an entrepreneurial culture. Measures could be profit per dollar of incentive pay, or maybe findings from employee surveys. See how it all connects back to being the cost leader.
Yeah, it really cascades the strategy down into measurable actions across the board. Very comprehensive.
Exactly. It ensures everyone's pulling together towards the same strategic objectives.
Okay, we've talked a lot about measuring performance, but what about the cost of not performing well? Specifically around quality. Our sources dig into the costs of quality. How do they define quality here?
Broadly speaking, quality here means a product's ability to meet or, ideally, exceed customer expectations. The cost of quality isn't just one number. It includes both the costs you incur to ensure good quality and the costs that arise from failing to achieve good quality.
Right, the idea of an ounce of prevention.
Worth a pound of cure.
Yeah.
Exactly. That's the core idea.
So there are costs for doing things right, the conformance costs. Let's break those down first.
Right. Conformance costs are spent to make sure things meet the standards. They fall into two main buckets. First, prevention costs. These are proactive costs incurred to prevent defects from happening in the first place. Think employee training on quality methods, inspecting raw materials before you use them, preventive maintenance on machines so they don't break down and cause errors, maybe redesigning a product or process to make it inherently higher quality, or searching for better suppliers.
Investing upfront to avoid problems.
Precisely. The second type of conformance cost is appraisal costs. These are costs incurred to find defects before the product gets shipped or moves to the next stage. This includes things like statistical quality checks during production, testing finished products, inspecting goods, maintaining test labs and equipment.
Finding the problems before the customer does.
Exactly. So prevention tries to stop them happening. Appraisal tries to catch them if they do. Both are about conforming to quality standards.
Okay, those are the good costs in a way. Then there are the non-conformance costs, the costs of messing up. These sound like the painful ones.
They absolutely are. These are the costs incurred because quality standards weren't met, and they also fall into two categories. First, internal failure costs. These happen when you catch a defect before the product leaves the company, but you still incur costs. Think rework, having to fix the defective item. Scrap, having to throw it away. Maybe tooling changes needed because of the defect. The cost of disposing of bad units. Production downtime caused by the quality issue. The cost of the lost unit itself.
Ouch. Still costly, even if the customer doesn't see it.
Very costly, but often less costly than the second category, external failure costs. These are the costs incurred when a defect is discovered after the product has reached the customer.
This is where it gets really bad.
Yeah, this is nightmare territory. Think warranty claims and repairs, the cost of handling returned goods, potential liability lawsuits if someone gets hurt, lost sales from unhappy customers who don't come back, damage to your brand reputation, maybe even needing a massive recall or re-engineering effort. These costs can be enormous and really hard to fully quantify sometimes, especially the reputational damage.
So the sources emphasize an inverse relationship here, right? Between investing in conformance and the level of non-conformance costs.
Absolutely. It's a fundamental trade-off. If you increase your investment in prevention and appraisal, the conformance costs, you should see a significant decrease in your internal and external failure costs, the non-conformance costs.
Spend more upfront, save much more later.
That's the principle.
Mm.
Conversely, if you try to skimp on prevention and appraisal, you're almost guaranteed to see your failure costs shoot up. It might look like you're saving money initially, but the downstream costs of failure often dwarf those savings.
And the Glass Products Inc. GPI example illustrates this perfectly. Can you walk us through that?
Yeah, GPI is a great case study for this. They had really high failure costs, lots of internal rework and downtime, plus external returns and lost customers. Big problems.
Right.
Then a new production manager comes in and makes strategic changes focused on quality. First week. Hires a quality technician to test products coming off the line. That's an appraisal cost catching defects early. Then They implement quarterly employee quality training, start regular preventative maintenance on machines, and have supervisors do weekly quality inspections. Those are all prevention costs stopping problems before they start.
So a clear investment in conformance, what happened?
The results were dramatic and fast. Within 6 months, production downtime dropped by 90%. Scrap costs were cut in half. And critically, they had far fewer product returns and, the report says, lost 0 customers due to quality issues in that period.
Wow, that's a powerful demonstration.
It really is. It shows vividly how that upfront investment in prevention and appraisal directly slashed those much larger, much more damaging internal and external failure costs. It paid off handsomely.
So wrapping this all up, for us learners trying to make sense of how organizations work, it's really clear that understanding performance is way more complex than just looking at the profit number.
Absolutely. You need that holistic view. You have to integrate the financial metrics with those vital non-financial indicators. You need the right tools like control charts or Pareto diagrams to diagnose what's really going on.
Yeah.
And you have to understand dynamics like the cost of quality, that investing proactively often saves enormous pain down the road. It's about seeing the whole system.
Yeah, building that complete picture, connecting the big strategy all the way down to the nitty-gritty of daily processes, and seeing how they all influence each other.
Which, raises an interesting question for everyone listening. How might understanding all these different ways to measure performance, financial, non-financial, quality, efficiency, reshape the way you evaluate success, whether that's in a business context, a project you're working on, or maybe even a personal goal?
Yeah.
Do you have your own sort of balanced scorecard for what truly matters to you?
Definitely something to chew on. That's all the time we have for this deep dive. Thanks so much for joining us as we explored the world of performance management. Until next time, keep digging for those insights.